CEO of Miri Asset Securities USA and the call's moderator. I am very pleased to welcome a true thought leader in the alternative investment industry, Keith Black, PhD, who has over 25 years of financial market experience, serving approximately half of that time as an academic and the other half as a trader and a consultant to institutional investors. He currently serves as Managing Director of Curriculum and Exams for the Kaya Association. During his most recent role at Ennis Knupp and Associates, Keith advised foundations, endowments, and pension funds on their asset allocation and manager selection strategies in hedge funds, commodities, and managed futures. He contributes regularly to the CFA Digest and is published in the Journal of Wealth Management, the Journal of Trading, the Journal of Investing, and the Journal of Alternative Investments, among others. He is also the author of a book entitled Managing a Hedge Fund, as well as co-author of the 2012 and 2015 and 16 second and third editions of the Kaya Level 1 and Level 2 textbooks. Dr. Black was named to the Institutional Investor Magazine's list of rising stars in hedge funds in 2010. But meet Keith, I want to thank the sponsors of the New York Hedge Fund Roundtable, which make events like this possible. And on the slide, you can see Alston Bird, Berg, Baker T, Grant Thornton, New Mountain Capital, Frenchel Systems, a new sponsor to the Hedge Fund Roundtable, as well as our nonprofit sponsors, including the CFA Institute and, of course, the Kaya Association. So welcome, Keith. The questions. So you want to take the slides? Okay. First question. Given some challenges before the industry, what do you think has to happen for hedge funds to reverse the negative asset flows experienced in 2016?
I think we need a good bear market. I think we need a stock pickers market. And so if you look at these 10-year statistics here, we see that the hedge funds, as measured by the HFRI fund-weighted composite, have had relatively disappointing returns over a 10-year period. But over 10 years, that hedge funds have had lower returns than U.S. stocks and global stocks. But even more importantly, we see that the 10-year return of hedge funds is below U.S. bonds and global bonds. And even when we move into alternative investments, we see that private equity, venture capital, and a number of real asset strategies have outperformed hedge funds over a much longer period of time. And so if we look specifically at hedge funds, a pre-quote survey says that 73% of investors are disappointed in performance, and 64% of investors are worried about fees. And so it's been a bit of a perfect storm for hedge funds. And the position of hedge funds to outperform stocks in a bull market, even though the media and a lot of investors seem to think that. The value position of hedge funds is to be able to be defensive in bear markets and provide alpha in both bull and bear markets. And so we need to benchmark hedge funds appropriately. We don't want to benchmark hedge funds relative to long-only equity indices, but we want to realize exactly how much beta is or is not in those hedge funds and measure them by their alpha. We're seeing a number of investors look at more creative fee structures. It's getting harder to earn 2 and 20 as a hedge fund manager. That number is now 1.5 and 15. But some other large investors are looking at more interesting fee structures that actually for alpha rather than beta, or maybe use a hurdle rate that acknowledges the beta risk within the specific hedge fund strategy.
Can I ask you a question on this slide? Who could this respond?
This is a Preqin survey, and Preqin works with institutional investors around the world, and so this would be pensions, sovereign wealth, endowments, and foundations that responded to a Preqin survey.
So, curiosity, to go back to a point that you made earlier, the goal of hedge funds is not necessarily to outperform, but it's to protect capital, right? Simple terms. Wouldn't you think that educated audience, like institutional investors, would key in on that point?
Well, they could, but hedge funds haven't necessarily the job the way people might have expected them to, right? And so if you look at the kind of the 10-year package of returns, 3.8% in return, 7.7% in volatility, and a drawdown of 19%. For over 10 years, you got a better pitch of risk and return from U.S. bonds and global bonds, but also timberland and farmland and even venture capital had better drawdowns and risk statistics than hedge funds. So even if you're not comparing it to a long equity benchmark, these other asset classes appear to be more attractive over the last 10 years.
Okay, thank you. Session? So, what we see is a trend in the asset allocation of high net worth investors, foundations, pension funds, and sovereign wealth funds?
Well, that people are more diversified, and that the core alternative asset classes that are held by the majority of institutional investors are private equity, hedge funds, and real estate, and they have been for quite some time. But we're seeing a lot of interest now in infrastructure, private debt, and natural resources, and relatively few institutional investors across all six of these categories. But we see a pretty negative trend again for hedge funds in the same survey, in that hedge funds are noted as the number one potential source of funds, where 31% of institutions are looking to reduce their allocation to hedge funds. But we're seeing a lot of other areas within the alternative space where institutions are looking to increase their allocations, and 48% in private equity and 36% in real estate, even though those are the alternative investment classes that a lot of institutions have already allocated to. But what's most interesting to me is that 53% of investors are looking to increase their allocation in infrastructure and 62% in private debt. So it's decidedly negative. As the sentiment is on hedge funds, it's exactly the opposite and very positive for the space in private debt. Look at endowments and foundations, we see that on average they have about 58% invested in alternative investments. These large endowments with over $1 billion in assets. So this is Harvard, Yale, MIT, Stanford, Texas, these very large investors. And so out of that 58% in alternative investments, they have 24% in hedge funds, 9% in private equity and venture capital, and 15% assets. And you see that these allocations generally increased from 2002 to 2008 to 2010 or so, and then they've kind of equivalent around those levels since 2008 to 2010. So we've kind of reached the maximum allocation to alternatives in foundations seems to be in that 55 to 61% range. We know that sovereign wealth funds have increased assets quite substantially in recent years, and so now sovereign wealth funds, as an investor group, have more assets than the world total of private equity and hedge fund investor capital. But while they're doubling their assets over the last decade or so, they've also substantially increased their assets in alternative investments. So we see now that more recently there's been about 27% allocation of sovereign wealth funds into alternative investments, up from just 15% in 2002. So foundations are a standout in their allocation to hedge funds at 19%, and then we have public pensions at 8 to 11% in hedge funds. We see constant private pensions, public pensions, as well as sovereign wealth at 5.5 to 6.5% in private equity, and 7 to 9% in real estate, and a relatively small asset class in the U.S. at infrastructure. We know that, especially in Canada, in Australia, we could see infrastructure as much as 15 to 20% in those pension funds. To draw a bit, we see that the equity, real estate, and infrastructure will continue to grow as an allocation across these investor types. And again, hedge funds are seen as a source of funds with maybe a 1% reduction in the AUM or the allocation across these institutional investors. And then we'll see private debt continuing to increase, maybe as much as by 2% of AUM just in the next couple of years.
Okay. What are the drivers of the continued outflows and consolidation in the hedge fund business currently?
So we see that according to HFR, that the number of single manager hedge funds took a big hit in 2008, 2009, and then bounced back pretty healthily. And so from 2012 or so on, we've had more single manager hedge funds than we had in 2007, and that number has leveled off somewhere above 8,000 single manager hedge funds. But we see that in 2007, 2008, there's about 2,000 fund of funds, and there's continued to be consolidation and attrition in the fund of fund space over the last 10 years. And now there's about 1,500 fund of funds, down from almost 2,500 around 2008. So we've already lost 40% of the global count of fund of funds business, and it doesn't appear to be up. In calendar 16, HFR estimated that 44% of single manager hedge funds had inflows, while 82% of fund of funds had outflows during calendar 2016. I think there's influence of quite a number of factors that have been hurting the fund of funds business, even though there's been substantial fee compression. Historically, we thought that fund of funds were able to charge fees of 1 in 10, and now for institutionally sized allocations, that's down to 50 basis points to 75 basis points without any incentive fee on the back end. I think part of it was that we've moved from individual allocations to to hedge funds into institutional allocations to hedge funds, as well as kind of the disappointing performance in 2008. So before 2008, funds were selling access to closed funds, and they're holding themselves out as due diligence experts. But in 2008, we saw that a number of fund of funds had allocated to Madoff and some other funds, and then some fund of funds had large allocations to relative value funds that had large losses in some structured credit issues in 2008, and so investors were saying the fees are high, and I'm not getting the asset allocation or the downside risk modification that I was hoping for. But more recently, we see that as much as 80% of the money in the hedge fund business now is coming from sovereign wealth, from pension funds, from these endowments and foundations, and the scale of the business is getting very, very large as well. And one consequence of this is that the big funds are getting bigger. And so because we have the pensions, the endowments, and the sovereign wealth funds investing in hedge funds, they have a due diligence process that they go through when they evaluate these funds. And we'd like to see risk mitigating factors in the way these hedge funds are built. So we'd like to see external administration. We'd like to see a risk that's separate from the PM. We'd like to see an external accounting group that's setting the NAVs rather than someone within the hedge fund. We'd like to see separation of duties from the accounting to the administration, and all of these things, including bulletproof trading systems. All of these things cost money, and so what we see is that on the left side, 6% of hedge fund management companies have over $5 billion in assets. 13% have $1 to $5 billion, and then 7% have $500 million to $1 billion in assets. And 7 plus 13 plus 6 is 26% of hedge fund management firms have over $500 million in assets. But look on the right side, you see that the $5 billion firms have 69% of the assets, the $1 billion firms have 21% of the assets, and then the $500 million firms have 4% of the assets. You add those together, it's about 94% of assets are controlled by these 25.5% of firms that have over $500 million. And so the institutions are now the allocations into hedge funds, and they're coming with bigger tickets into big funds. And so these large institutions that are allocating to hedge funds, they don't need the diversification that's offered by a fund of funds, where an individual might invest $5 million to invest across 20 different hedge funds. The institution is investing $5 million in each hedge fund, and they're easily building a $100 million portfolio across 20 different hedge funds. And so because the institutional investors are coming with scale, they don't need that diversification that's given to them by the fund of funds. But at this time, we see that the consultants are becoming fund of funds are becoming consultants, and then you've got this whole outsourced CIO business, and maybe the outsourced CIOs and the consultants are charging flat fees that might be much less than 1 in 10, and so I think the biggest part of this is not necessarily a disappointment in the business model of fund of funds, but that hedge funds overall had a low return decade. 1 in 10 on a net return of 3.8% is a pretty high fee. But I think probably the biggest driver is that these large institutional investors are doing a buy versus build analysis. So rather than paying 1 in 10 or even 50 basis points to the fund of funds manager, what does it cost me an in-house team to perform the due diligence and make the allocations? And I think that the biggest issue for fund of funds is that these institutional investors have the scale and the knowledge to invest directly with the underlying hedge fund managers, and rather than using the fund of funds as an intermediary. And the consultants and the outside CIOs are kind of adding insult to injury that even after institutions have the ability to go direct, those that don't might be going through a consulting firm or an outsourced CIO firm rather than a fund of funds manager.
This is a very interesting slide. I'm curious to see if you have any thoughts on trends in performance based on AUM size.
It's always a difficult question to answer because not every hedge fund will report to a database. So you could look in HFR, you could look in Preqin or any other database, but at the end of the day, it's voluntary to report performance to a hedge fund database, and so there's evidence both ways. There's evidence that the largest funds with the best returns, they have their institutional network. They don't need new assets. Maybe they're close to new investors, and so the large funds with very high returns might not be reporting to the databases. And you might have the emerging managers and the small managers, where if they have really good returns, they have an incentive to report to the database, so they'll be found by investors. But the emerging managers who don't have great returns might be kind of embarrassed to report to the database, and so different investors might see it both ways. That the best funds are left out of the databases, or maybe the worst funds are left out of the databases, and so we can answer this question with certainty. Certainly there's people who believe in emerging managers and them having the small asset size and kind of the aggressive nature to put up some big numbers, but maybe the small asset size and the aggressive ability to put up big numbers might be causing them to take kind of outsized risks as well. So it's not really a question we could answer, but one thing we do know is that the smart funds have a larger probability of liquidating. That's not necessarily because they much risk or they don't have great returns. Number one reason that funds close is that 5% of funds have less than $100 million in assets, and they're sharing 1.2% of industry assets, and so you can imagine someone who was a prop trader at a bank. They got a big bonus for a couple of years, and the bank kind of downsized due to the broker role, and they got rid of the prop trading desk, and the trader says, "Oh, I could do this on my own. I'm going to sit at home and trade with my $20 million and try and get some friends and family involved." And they do a perfectly respectable job, but they realize that it's not just good returns. You actually need the legal infrastructure, the accounting infrastructure. You need someone to go out and find assets, and you do this for a couple of years, and your spouse comes up to you and says, would give it up already. You're sitting at home, you're miserable, you're trading all day, and you're making half as much money as you were making at the bank because you weren't able to scale. And I think the number one cause of hedge fund mortality is exactly that. It's the fail to scale to an economic size rather than something catastrophic happening in the hedge fund with very large returns.
Break even, obviously, if you less than 100 million.
Right. And it's the scale you need. It's hard to get the external investors. It's hard to get that 3-year track record. And at the end of the day, the institutions who write the big tickets, they will see, not two people, a Bloomberg and a dog. They want to see 12 people with the robust systems and the separation of duties and the external accounting and all of that. It's very expensive to pass these institutional due diligence processes in a way that the $20 million manager isn't able to make investments.
You had alluded earlier to the fact that ODD has become much more front and center in recent years than it was, let's say, 15 or 20 years ago, certainly.
Right, and you could thank Bernie Madoff and some others for that. And so one thing we see now is external administration is almost a must-have now. Before 2008, there was a lot of firms who did a credible job of internal administration, but institutional investors say, I know you're probably really good at it, but I just can't take that risk. I need that external verification of the assets and returns, rather than the hedge fund manager, telling me what they think the returns are.
Moving right along here, in the Hedge Fund Roundtable's January meeting with Mark Yusko at Bloomberg, he equated the steady rise in market indexes with quantitative easing and a consequent lack of volatility, which you referred to earlier, Keith. Assuming the Fed shrinks its balance sheet, how do you see this impacting hedge funds?
In the first question you asked me, how can hedge funds reverse the negative asset flows? And I said we need a good bear market, and we need a stock pickers market. And what is the impact of QE? What is the impact of low volatility? If you look at this chart, we have a 3-year rolling sector correlation to the S&P 500, and so we look at consumer discretionary, healthcare, utilities, staples, industrials, energy, materials, financials, and tech, and we compare the correlation of those sectors relative to the S&P from 2001 and until this year. And you see that amazingly placid period between 2008 and 2013 or so, where every single sector for 6 straight years had a correlation above 0.8 to the underlying index. And so what this says is we had a risk-on, risk-off market. And people aren't making distinctions between sectors, and people aren't making distinctions between stocks. They're saying, I want to be in stocks or I want to be out of stocks. And I'm not making any relative value decisions within stocks. But look how quiet things were from 2008 to 2013 or so. And then compare that to the 2001 to 2007. We had years where half the sectors had a correlation of less than 0.6, and so you could really add a lot of value being in or out of financials or tech or energy, and in this risk-on, risk-off market, sector picking and stock picking really didn't make much of a difference. But over the last year or so, we're really starting to see those correlations break down. Especially since the election. And if you've heard, the Trump trade is on or the Trump trade is off, that's not saying the market as a whole is going up or not. It's saying that the forward-looking scenario for energy, or the forward-looking scenario for dirty energy or coal or financials or healthcare might diverge rather substantially from the rest of the market, and so you could imagine how well a hedge fund can differentiate themselves if they just had a one-day lead on what Trump was going to tweet about, and now we've got this idea of a stock picker's market, and if you're in or out of the right sector, or if you're in or out of the right stock, it's starting to make a difference. And so this is kind of a prerequisite for equity hedge funds to have better performance, because if sectors and stocks are starting to differentiate themselves from each other, now we've got a lot more trading opportunity. And if you look at the substantial difference in returns of tech versus healthcare versus energy versus financials, and the big lag of utilities recently, you have very substantial stock pickers opportunity. But we're looking at what the Fed is doing and higher rates. And so certainly if we go from 2% Treasury or Fed funds up to 5%, people will be more interested in investing in fixed income. That might pull some assets away from equities, or it might pull some assets away from hedge funds. But there could be substantial stock picking opportunity. But if people believe that funds and alternatives are kind of built around bear market performance, if the Fed takes away the punch bowl and we have a return to something that's not 11 VIX kind of market, if alternative investments and hedge funds specifically have an ability to post even flat performance in a big equity market, then the assets will come flowing back into the hedge fund space.
So it would seem as if Yusko's comment was spot on. If you look at the SPX line, that dark black line, it almost moved in lockstep with the increase in the size of the Fed's balance sheet. And when the punch bowl gets pulled.
You're going to say when, but I think it started. The question is kind of how quickly things are going to rise and what the impact is going to be.
And Yusko made another comment that I just would love to get your view on. He said that as volatility returns, that he saw a opportunity for smaller managers to business. Do you have any thoughts on that?
Well,
given everything you've just said about large and small managers, I'm just curious to get your view.
Right, and maybe the headwind against the small managers is this lack of dispersion. Right, it's hard to find those outside trades, but when things start really moving, that increases both the risk and the opportunity. And so if markets are at a 20 VIX or a 30 VIX for some time rather than around 10, you're going to see kind of an increase in the managers on both ends of the spectrum. You'll see an increase in hedge fund mortality and large losses, but you'll also see some managers being able to put up some outsized returns that have been harder to find in the low vol environment in the last couple of years.
Okay. Private equity and venture capital dry powder so high, and IPO and exit activity so low, the new highs in the equity markets.
But equity's always been a core asset class, and depending on who you ask, everyone has a different idea of how big this is. But if you look at private capital more broadly, between private equity, private debt, real estate, infrastructure, natural resources, this is about a $4.5 trillion business, and something the number might be twice that. You could see here in red the tremendous growth in the private debt, and then the blue and purple the significant growth in infrastructure and natural resources. So we've got about $2.5 billion in private equity, and $800 billion of that is held in dry powder. So the private equity buyouts and the private equity venture are certainly that dry powder, and so we see that over 500 billion of that dry powder is in the buyout space, and then another almost 200 billion is in the venture space. But you're contrasting, why is there so much growth in private equity and private equity dry powder relative to the IPO activity? And we see here that for years we've seen capitals be much larger than capital distributed, and so the private equity funds haven't had the exit opportunities that you'd like them to have, and it seems strange that we're making new highs every day in the equity markets when we've got relatively low IPO activity. We see that the rate of venture has been very strong. So when the lines here are pointing higher, we see that venture capital has had returns higher than the Russell 2000, but in 2015 and 2016, that Russell 2000 returns were actually higher than we saw for the venture capital universe. But one thing that's astounding to me is in this chart, and we see here the number of venture capital deals by region, and we see that venture capital activity in the U.S. in blue has declined, and in the U.S. and in Europe in red it's declined. But look at the astounding growth in venture capital activity in China. Equity and venture managers have been flocking to China, and so in 2016 we had $61 billion of venture capital investment in the U.S., which is down 24% in the number of deals and 15% in the aggregate value from 2015. We see aggregate value declining by 16% in Europe, but growing by 20% in China. So now in 2016, there's $48 billion of venture capital interest in China as opposed to $61 billion in the U.S. But I think part of this reticence to invest and the reticence to IPOs is based on this unicorn market, and there's a saying in venture capital that IPOs are the new down round, and so if you look at recent IPOs, if you look at Square, if you look at Cloudera or Box or Hortonworks, Groupon and Zynga, a lot of these companies they either came with the IPO as a down round, where the valuation in the public markets was actually lower than their valuation as a venture-backed company, and if they didn't have a down round, they had a relatively unsuccessful IPO. We've seen that Works or Cloudera or Groupon or Zynga, their price as a public company is below their price as a venture company, and the problem is now we've got 80 unicorns, which are private companies with $1 billion market cap, and you put them together and $1 billion. But you look at Square and Cloudera and Box and Hortonworks and Groupon and Zynga, every single one of those has negative earnings, even though some of them have been public for years. And so a lot of the entrepreneurs are saying, I don't want to be public. Why should I go public if I could have $600 billion of market cap as a private company or as a group of unicorns? So if it's easy to get funding as a private company, if we don't have to file public financial statements, if we don't have the price discipline of the public markets and having to deal with Dodd-Frank and Reg FD and all of this kind of mess, the entrepreneurs are saying, what's the point of being publicly traded? And the venture capitalists are saying, well, why should I invest in these companies if they have $1 billion valuation and a negative cash flow? If the entrepreneur doesn't want to go public, or if the track record as a public company is going to be a down round. And so if I'm valued at $30 a share as a private company, and my IPO is going to be at 22, that seems counterproductive to have a down round when I'm going into the IPO market. Especially when I have to maintain the valuation I had on the private side.
Keith, if I may, can I ask you to go back to slide 27 for a second? I have a question. Curious about the growth in natural resources investing over this period. How do we define natural resources here?
Natural resources could be an illiquid or a liquid investment. Maybe you're buying into an oil well or a gold mine, or maybe you're allocating to commodity futures or some other kind of liquid commodity investment. And so there's been a lot of money going into that natural resources space. We could look a little deeper into the natural resources space. Maybe it's agriculture and farmland, metals and mining, timberland, water investments. But what people are really interested in is the energy and the renewable energy. So I'm buying a coal mine, I'm buying an oil well, I'm making these investments in shale gas. On the other side, and it's actually taken after the election, the most attractive sector for people is renewable energy. People are really interested in building these wind farms and in building these solar farms, or in finding some technological solution that could clean the environment or present solutions to climate change.
So doesn't it seem as if the interest and growth in natural resource investing during this period, particularly over the last several years, is a bit counterintuitive than the performance of this sector in the public markets?
Well, we're actually thinking that it's a value. So the market's the only place where people run away when something's put on sale. So if you go to the shopping mall on Black Friday, the malls are mobbed because everyone wants to buy something for half off. But when energy assets are at half off, no one wants to invest in them. But if you look in the long run, if we want to rebalance our portfolio, we've had tremendous gains in equities, in real estate, in fixed income, with a time of relatively low inflation. But I don't think that the demand for commodities is going to zero. I mean, we need need renewable energy. We need trees and water and food and all of these things as the planet becomes more crowded. And if you look on a relative basis, if go back to the very beginning about what returns have done over the last decade, we see that stocks have risen, bonds have risen, farmland and real estate and private equity have risen, and the price of commodities over the last 10 years has been cut in half. And so if you believe in strategic asset allocation for a 20-year period, if you believe that there's a value to investing in these resource areas, if you believe that there's scarcity in some of these areas, it makes sense, even if you're rebalancing back to your strategic asset allocation. If you say, I want to have 5% of my portfolio in natural resources, what you need to be doing is constantly selling fixed income and selling private equity, and selling equity and using the proceeds to reinvest in natural resources after this big drawdown.
So can we infer by this that is a bit of a leading indicator, or where smart money goes?
In many portfolios for a very long time, we've known that private equity and venture capital are the highest performing asset class. And over 25 years in the U.S., we've had private equity and venture capital be 300 to 400 basis points above equity indices. And if you look at the Yale model, some people say there's nothing magic about Yale at all. It's just that they allocated in a big way to the right private equity and venture capital managers, and compounded returns of 25 to 30% over 25 to 30 years. And so there's always been a very high potential return and a high potential risk when you invest in private equity and venture capital. And nobody would invest in private equity and venture capital if they thought they were going to get returns lower than public equities and have to tie up their money for 10 years or longer.
Okay. Let's move on to private debt then. What we see is the driving force in increased investor interest in private debt.
Started off by showing that the private debt is the number one asset class that institutional investors are looking to allocate to, and we could see 200 basis points of institutional allocations come into private debt, even though we've had 3 times the assets come into the space over 10 years. And explicitly talk about Basel III or Dodd-Frank, but I think private debt is an opportunity that's come out of that. And so if you look at bank stress test, if you look at the capital adequacy requirements, if you look at banking regulators around the world, they're looking to increase capital and reduce risk. And so what we've seen is that in many cases this middle market lending, or the lending for LBOs, has been kind of a prime victim of this reduction in risk appetite by the banking sector. And so there's an increasing portion of the global economy that has a need for capital that aren't willing to provide on an economic basis. And so what we're seeing now in this private debt market is that if the banks aren't underwriting loans, the pension will. If the banks aren't underwriting loans, and private equity will.
So shadow banks have stepped in to fill, in many cases, the void left by those entities, deposit-taking institutions that are regulated by Basel III.
That's right, and so the companies have a need for the capital, and the banks aren't providing it. And so we've seen capital coming into the space, but part of this is also that reaching for yield, right? People don't like investing in 0% money markets or 2% treasuries, and we've seen people reaching for yield in all kinds of ways. We've seen record flows into junk bonds. We've seen people investing in emerging market debt, or even investing in high dividend equities and MLPs, thinking of them as fixed income substitutes, even though we know they've got significantly more risk than the money market or treasuries we were leaving, with 5 to 7% yield a decade ago. And so we're seeing the majority of this money coming into the direct lending, distressed debt, and the mezzanine space. So that's almost 80% of the assets are coming into those spaces, and the current yield in those areas is kind of 7.5% to 9% that we're seeing in these kind of loans. There are substantially riskier loan types with 10 to 20% yields, but we see that those are a much smaller part of this universe. And so what we're seeing is pension funds, banks, or pension funds, hedge funds, and private equity funds, they're finding these middle market companies or they're finding these LBO sponsors, and they're underwriting these loans with coupons or total yields of 7.5 to 9%.
Okay. You mentioned REITs before. So what are the potential outcomes of recent REIT outperformance relative to private real estate funds?
If we look at what's going on in real estate, remember performance and fees were the number one issues with hedge funds, and those aren't in the top 5 issues in real estate. People have been pretty happy with real estate performance over the last decade, and performance and fees aren't the issue, but people are starting to get worried about valuations. And so when we go into real estate, we could buy buildings directly. We could go into institutional private equity funds that will hold portfolios of properties, or we can invest in REITs in the public markets. But what's been really concerning is the performance difference between REITs and private real estate. And so when the lines here are pointing up, we see that the private real estate investments are outperforming the REITs, and then when the lines are pointing down here, we see that the REITs are outperforming the state. And the magnitude of this is actually pretty concerning. And so we see the rear in the purple line, and private real estates in the blue and the red, and we see that since the bottom of the market in 08, 09, where all 3 of these lines crossed at similar levels of valuations, we've seen that REITs have outperformed private real estate 50 percentage points in just 2 years, and so that says that the public markets have really gotten ahead of where the private markets are. And so the implication here, if you own a portfolio of private real estate, you have an incentive to go into the REIT structure and try to earn some of that premium valuation on the public assets, or that holding REITs looks to be a more risky way of owning real estate than in the private market structure, because over 10 years, over 20 years, we'd expect REITs and private real estate to have approximately the same returns, because they both own the same type of hotels, the same type of office buildings, same type of multifamily properties, and the difference is just the wrapper and the liquidity. And so we can't imagine a scenario where REITs over 20 years would have twice the returns of private real estate when they own the same type of properties as the underlying.
Yes. Wow. Do we from the audience? Very interesting and thought-provoking conversation with Keith Black. Keith, you leave us with a lot to think about. I like that slide 27. I thought that was very interesting. The comment that you made about natural resources, and try to find the other slide where you had the returns. I guess that's an earlier slide. Commodities down 66%, ending September. And what was that time period, by the way?
That's the 10 years ending in September of 16.
And so it would seem that MSI World opportunity areas potentially.
And have to think about what the trailing returns have been, and so over 10 years you've seen U.S. stocks outperform global stocks. Part of that is due to a strong dollar, but part of that's due to kind of outperformance in profit opportunities in U.S. companies. But a lot of people are really calling for a turning point in European equities after the election of Macron, and it looks like the euro is going to stay together, and Macron's going to be pro-growth leader in France, and so a lot of people are saying that maybe the earnings per opportunities in European companies should turn around, and a lot of this is just about rebalancing. We don't think we could get a 5% return on bonds, investment grade bonds starting at this point, right? If you're running at 0 or 2 or 4% coupons, it's hard to get a 5% return on that over a 10-year period. We've had big return to U.S. stocks, big return to the dollar, and a lot of this might just be reversion to the mean. If the dollar doesn't stay strong forever, and foreign companies are starting to turn around in their profit outlooks. Personally, I'm overweight in U.S. stocks relative to U.S. stocks because I believe that foreign currencies might have some strength relative to the dollar going forward.
Well, given that comment, do you have any thoughts on either gold or Bitcoin?
I caution against allocating to Bitcoin at this point. We know that over 80% of the Bitcoin trading is in China, and a big part of the way the Bitcoin is going is either pure speculation or evading capital controls or regulation in some kind of way. We don't see that as a store of value that you might see with gold. Recently Bitcoin's had as much as 20% daily volatility, and that's not something you want to have a large allocation to. But if you want to buy a handful of coins, maybe it could be a large allocation going forward. But at the beginning of this year, the global market cap of Bitcoin was $17 billion. Yeah. And so it gets a lot of press, but there's single hedge funds that are larger than the Bitcoin market.
Gold.
Gold is like a currency. It's like a store of value. I wouldn't put it in the same bucket as commodities, because if you look at energy, or if you look at agricultural products, we know that we've got a population with growing income, especially in emerging markets, and they're going to continue to consume more energy, and they're going to continue to consume more agricultural products, but we don't consume gold. We don't care about this year's mining or this year's industrial absorption of the gold market. And so I would treat gold as a currency or a store of value rather than as an energy or an ag commodity that has a need to be consumed.
View of your comment about the strength of the dollar, the possible rotation away from dollar to foreign currencies, and in view of your comment that gold, among other things, is viewed as a monetary asset. What is your view of gold?
That it could be a store of value, and historically, when the dollar is weak, or there's been kind of geopolitical risk in the world, gold has been one of the firmer assets during those times of crisis.
Okay. Well, it is 1:00. I think we've run out of time. I do want to thank you for, as I said, a very in-depth and thought-provoking presentation. I assume that if anyone is interested in seeing the full presentation, we can make that available?
I believe we can.
So I want to thank you, and we are out of time. So thank you very much, Keith. Black of Kaya, and wish everyone a good month. Welcome to summer, and we'll see you next month for the July call.
Thanks, Bob. I appreciate the invitation to speak.
Yeah, this was very interesting. Thanks so much, Keith.
Thank you.
Bye-bye.